Open any Facebook card group. Scroll for 30 seconds. You'll find the post. Big block letters. Cash in hand. Buying all your cards. 80% of comp. You see it everywhere. 80%. And 60% of the time, it works every time. Same post Monday, different account Tuesday. By Friday, it's 5 of them running the same play in the same group. Nobody asks why it's 80. Today, we ask why it's 80. And then we ask a harder question. Why you keep saying yes. Here's what I want you to notice first. The number is specific. Sometimes it's a range, but usually it's specific. It's a stated price, 80%. That level of confidence about a single number in a market with tens of thousands of players, tens of millions of cards, and no centralized price discovery should feel strange to you. It doesn't feel strange, though, because you've seen that number so many times, it looks like straight math. It looks like something someone figured out once and codified. Someone did figure it out once. That's the part that nobody talks about. See, the 80% rule didn't just fall out of the sky. It came from a specific piece of math for a specific type of transaction at a specific moment in the hobby's development. The math still works for that transaction. It does not work for the one you're being offered. See, that gap is where most of the money in this hobby disappears. Not in bad grades, not in bad timing, but in accepted bids that shouldn't have been accepted. So let's walk through it. The 80% rule, where it came from, why the flipper is not wrong to use it, and why you should be careful about selling into it. Now, before we critique the 80% rule, let's understand it first. Because if your argument against it is flippers are greedy, you've already lost. The math is going to be cleaner than that. So let's dive into the numbers. eBay's final value fee on sports cards is usually 13.25%. Let's say a seller pays a further 2% on the promoted listings advertisement so we can get some marketing, and then roughly 1% goes into shipping materials. Now, let's look at a flipper buying a card at 80% and selling at 100. After fees, they're going to net about 83.75%. So their net margin is 3.75% for their time. Now, first of all, even if that seller that you are going to sell into is paying all those expensive fees, that 3.75%, which sounds like almost nothing, is not nothing. If you turn that inventory in 2 weeks, that 5% compounds into 160% annualized returns. Sales velocity does the work here that margin can't. For more on this, check out my Slabnomics podcast episodes, Time is Money in Sports Cards, which was from December 2nd, 2025, and Liquidity 101 on October 7th, 2025. Getting back to it, secondly, a serious seller may tell you that this is his math, but I can assure you that he isn't moving all of his inventory on eBay and losing 15.25% in platform fees. I'll tell you that right now. There are far more profitable channels using different marketplaces or storefronts or selling in person to take that cost down considerably. Let's take this one step further and say that this serious seller gets a nice deal and only pays 10% in platform fees, taking home 9% on that flip every 2 weeks. This annualized return of 9% becomes over 8x, 840% a year. Now, before you get your pitchfork out of the garden shed and head to the card show, these numbers are assuming that every single trade holds to that 100% comp value and that the seller can flip it within 2 weeks. Those are two big things. Here's what most seller-side commentary misses. The flipper is providing a service. They are accepting inventory risk that you yourself don't want to carry, and they're giving you immediacy. They're absorbing the comp drift that happens between the moment they buy and the moment they sell. If the market moves against them between their buy and their sell times, they're going to have to eat that loss. You already have the cash. In this way, the 80% isn't really a lowball. It's the minimum viable bid for someone running a high turnover strategy on eBay. Any higher and the margin disappears into a single return or a comp that softens while they're holding it. Any lower and sellers just won't sell. That's the definition here of a market maker. Every market has them. Citadel has them. The floor of the NYSE has them. Every used car dealer in America is one. Every pawn shop, every wholesale real estate buyer, they all operate like this. They all earn their spread, which is the amount between the buyer bid and the seller bid, by holding risk. That's what a spread really is. So when someone might say to you, flippers are ripping you off, the analytically honest response is not necessarily. They're earning a spread for a service. The question, though, the key question, is whether the service is worth the spread. And then further, whether the spread is being calculated correctly for the transaction you are facing on that Facebook group or that local card show. That second question, that's where this episode lives. Every market has a spread, as we've seen. The question is really how wide. So let's look at a couple other markets. In the S&P 500, bid-ask spreads are fractions of a penny. Pick a stock like Apple or Nvidia with $1 trillion market cap, and the gap between what a buyer will pay and a seller will sell is essentially zero. That's what deep liquidity looks like. Contrast that to private company shares. These spreads can run 30 to 50%. There are no continuous buyers. There's no centralized exchange. Each transaction is negotiated individually, with both parties guessing at what the value really is. That's another reason why when you see a company IPO, their price spikes immediately the second they go on the market. Used cars are another good example of this bid-ask spread. These trade at 15 to 25% the dealer spreads. Pawn shops will give you 25 to 40% of the wholesale value of something. Nobody calls that unfair because pawn shops exist for a specific transaction. You need cash today, you don't want to sell, and you want to have the option to reclaim the item. That's an expensive combination. The spread thus prices that combination. So here's the frame for you. A 20% spread on sports cards is not really insane when you look at it that way. It's in the fair zone for an alternative asset with thin liquidity and real condition risk. And some of your cards probably check that box. Now, before I turn to another thing, let me give you a historical note for context, because you'll know I like getting into the history. The 80-20 number you keep seeing in business books comes from Vilfredo Pareto in 1896. He noticed that 80% of Italian land was owned by 20% of the population only. That ratio turned out to repeat itself across an astonishing number of systems, even today. Retail sales, software bugs, Bitcoin wallets, net worth distribution, they all follow Pareto. So the numbers 80 and 20 are real numbers with deep structure behind them. Pareto distributions are not folklore. They show up because they reflect how power and resources concentrate in complex systems. Here's a subtle point for you. The 80% in Pareto's distribution is about ownership concentration. The 80% in a flipper's offer is about anchoring. Those are two different 80s. But because the number is the same, it feels mathematical, right? It feels baked in. It isn't, which is going to bring us to one of the biggest takeaways of today. If there is one thing I want you to take away from this episode of Slapnomics, it is that the 80% rule was built for bulk. It was never designed for singles. And somewhere along the way, it migrated from one to the other, and nobody has updated the math. Here's what 80% means when it's done right. A buyer says, I'll take your entire collection, 500 cards, sight unseen, and I'll wire you cash this week. Now, in that case, they're absorbing an enormous amount of risk. They have to sort every card. They have to authenticate every card. They have to decide which ones are worth grading. They have to list, ship, manage every single one. They have to carry the inventory for months, possibly longer. Some of the cards are probably unsellable. Some may grade poorly. Some will sit in their inventory forever. Shows like Chasing Cardboard have this prominently featured with Ty. He does a great job of explaining these kind of things. So when buying collections, 80% is not a lowball. It's probably fair. It might even be generous. The buyer is providing sorting labor, authentication risk, capital lockup, and inventory risk across hundreds of positions at once. That's what the 80% rule was built for. That's where math holds. But after talking about that, let me describe what's actually happening in most of these Facebook posts. Someone tells you they'll be buying heavy, buying strong. So people in the comments post their single cards. Slabbed, PSA 10s, PSA 9s. They have known comps. They have recent sales on Card Ladder or Market Movers. You can pull up the sold listings on eBay in under 10 seconds. There's no sorting to do. There's no authentication to do some of the time. There's no inventory problem because the buyer has one card coming in and one card going out. The hold period is measured in weeks, probably not months. So the flipper offers 80% on this. What risk are they compensating for here? Most of the time, they're focusing on liquid cards that always move anyways. The platform fees, those are real, but often in the single digits. And the comp drift risk between the time they buy and the time they sell, this exists, but it's pretty small on one liquid single sale over a 2 to 4 week window. Normally, they're pretty keyed in on trends too, so they've identified that the reward in the next 2 weeks is probably, aka from probability, higher than the risk. At a reasonable margin for their trouble, and you could probably get to a fair bid somewhere around 90 to 94%, not 80. The bulk rate should not apply to singles. And yet many times you see it does. You go through those posts and you see so many people commenting their cards on there. Culturally, this is because the flippers decided the 80% rule matters. And often enough prospective sellers are desperate enough to give in. The number leaked. It was built for a transaction with high inventory risk, authentication friction, and long capital lockup, and now it's being applied to transactions with almost none of these features. The labor is different, the risk is different, the hold period is different. The math is different. But the number stayed the same. This is the part of the hobby nobody is calling out, the bulk rate running the singles game. And if you're a flipper listening to this, I want to be direct with you. I flip cards myself. I'm not calling you unethical, but I'm saying that your pricing model is lazy. You're quoting your bulk number on transactions that don't warrant bulk pricing. You can still make your margin on singles, but if all you do is offer 80%, when the market goes south, no one's going to want to deal with you. It boils down to when people feel they're treated fairly, you get repeat business. Capitalizing on people's desperation is a quick buck, but a broken long-term business. And I'm going to give you the most important reason why this is bad policy a little bit later. For a liquid single, the fair market maker bid is in the low 90s. Any bid below that on a card with tight comps and real volume is not a compensation for risk. It's rent extraction from sellers who may not have thought through the long game. So if the bulk rate doesn't apply, why do sellers keep accepting it? The answer isn't weakness. The answer is that the human mind is vulnerable to 3 specific forces, and this particular transaction hits all 3 at once. The first is something I've talked a lot about called anchoring. Anchoring is a cognitive bias documented by Kahneman in Thinking Fast and Slow. When the mind is given a number to start with, it uses that number as the reference point, even when the number might be arbitrary. Experiment after experiment has shown that people who are shown a high number before estimating a value estimate higher. People shown a low number estimate lower. The anchor moves the estimate even when the anchor is irrelevant, even when that number has no bearing with the number they're asking you to estimate. So when a buyer posts 80% of comp, they're setting the anchor on you. They're placing the number in your mind before you've done any independent math. Your brain isn't starting from a blank page and arriving at 80. Your brain starts at 80 and negotiates around that point. This is why buyers state the number first. They're not asking you what you want. They're installing their number as the reference, as the anchor. Don't let the anchor drag you down. The second factor I want to talk about is herding. Herding is a bias that leads people to copy the behavior of others on the assumption that the crowd has information that they don't. In Facebook groups, you see the 80% post 10 times a week, probably more, And you also see sellers respond to it. You see 120 comments on there with photos. The environment tells your brain over and over, 80% is the market, 80% is the market. That's not just one number. That's not just for desperate sellers. That's the market. That's what is accepted generally. This is the residue of forced sales and anchored negotiations. But the signal to your brain is identical to the signal a stock trader gets from a price chart. You see a level that keeps getting hit, and you start to believe that that level is real. The third and final factor here is called hyperbolic discounting. This is a fancy term that just means people will take $80 today over $95 3 weeks from now, even when the math says to wait. The further in the future the payoff, the steeper the discount. We are wired for the now. Now you understand a little bit more psychologically what's going on in our brains. It's the exact machinery that payday lenders use. It's the machinery that pawn shops use, and it's the machinery that bulk card buyers use. Cash in hand today. It's the exact phrase that activates the discount, and it shifts your evaluation from the comp to the immediacy. So let's apply this to what we're talking about and put all of them together. An anchor installs 80 as that reference. The herd confirms that 80% is the market, and a discount mechanism is there for you getting that 80 today and not having to wait until that sells higher. Now, one more thing I want to bring up here that's really savvy. It's called disqualification. And the sales research on this is clear. Lowball offers in these public forums aren't designed to close the average prospect. They're designed to filter for the minority of sellers who will accept them. In marketing language, it's called racking the shotgun. You send out a signal that most will ignore, and the few who respond are the ones you want to talk to. The desperate, the new, the uninformed. And that's why the post looks the way it does. Low effort, same wording every time, no personalization. The post is not trying to persuade you, it's trying to sort you. The message is, if you take 80%, respond. If you won't, just scroll past. Nothing to see here. So, all in all, this is not a moral failing of the buyer. It's a rational filter. Knowing it exists, though, should change how you read the post, and I'm going to give you what I think in a minute. In fact, let's do it right now. Because here's the part of all this that matters most for the hobby, not just for you or me trying to buy a card on a Facebook group. When you accept 80, you break the price discovery of the market. This is George Soros's theory of reflexivity applied to a card market. Market participants don't just observe prices, they create them. Because that 80% buy happened privately, it's not going to hit the market, so the next public price is still at that 100%, which is exactly what allows the flipper to take your 80 and bring it to 100. This is the biggest advantage of a private sale for that flipper. If you had sold it on an eBay auction at 80% of the last price, that's now the new comp, and this doesn't work. But if you sell it privately at 80%, the market still thinks the last comp is that 100% mark. This isn't hypothetical. This is how every market with murky price discovery behaves. This drives some of the crazy price points that we see in the card market. So let's get practical. I have an ask for you, a very direct one. Stop posting pictures under the 80% buying posts. Stop responding. Stop engaging. And if you have friends that you've seen do this, send them this episode, please, to help educate them. This isn't just a moral argument, it's a market structure argument. Every time you reply with, "Here's my card," you're telling the buyer his strategy works. You're reinforcing that to him. You're telling the group that the number is fair and that they should hop on this train. And you're setting the anchor for the herd that's watching. Now, if you genuinely need the cash today and you've weighed the options and you understand that you're paying a 20% convenience fee for immediacy, then fine, that's your call. There's no shame in a liquidity trade. Pawn shops do exist for a reason. But if you're responding because you saw the post and thought, that's the market, that's not the market. That's an anchor. And those guys aren't your friends. The only way to weaken the anchor is to stop reinforcing it. The 80% rule is not going to collapse because my podcast called it out, but it will collapse when sellers stop feeding it. So my plea for the 90% of you listening who are sellers is simple. Stand firm. When you see the post, recognize it for what it is, a bulk rate being applied to a single transaction, a filter being cast for sellers who will take the first number offered, an anchor installed into the group's consciousness week after week, relying on you to normalize it. Don't. And for the 10% who are on the buying side, the mid-size resellers, the grading dealers, the people quoting those numbers in Facebook groups, you know the difference between a bulk deal and a single transaction, hopefully. Hopefully you know the math and you know how to keep your books. Quote the number that fits the deal and doesn't kill our hobby by preying on the uninformed and the desperate. You'll still make your margin, you'll keep more people in the hobby, and you'll have long-standing business relationships. So, 2 things I want you to do when you see those posts. First, when you see buying at 80%, scroll past, do not engage, starve that post. Second move, if you do happen to take a private offer, counter at 92% for slab singles with clean comps. Explain the math if they try and push back on you. If the buyer walks, they were never going to pay you a fair price anyways. And if they counter at 88% or 90%, you've moved the midpoint quite a bit, and that will add up over a lot of transactions. If you're new to the sports car game, the worst moment to sell is the moment you feel forced. If you need cash and your only timeline is today, you're going to take whatever number you can get. Understand that and prepare for that. Act before whatever bill or looming expense shakes out. Know your numbers. If you can give yourself even 2 weeks of patience, your position changes completely. I've said this before, liquidity isn't just a number, liquidity is freedom. I definitely want to reinforce that here for you guys. So, to sum all this up, the 80% rule is not a law of the universe. It's an anchor that got planted in this hobby's culture a decade ago when buying bulk was how most transactions happened, and it never updated when the market did. The math behind it was always for a specific kind of deal. Somewhere the deal changed, but the number stayed. And remember, flippers aren't the villain here. They're market makers earning their spread, and the problem isn't the 80%. The problem is the generalization of the 80%, from a bulk rule to a default on transactions that don't warrant it in any way. The problem is that it hurts new entrants into the hobby who should be protected so that the hobby can grow. Please share this episode with a friend or two who are getting into cards. 3 seconds from you will help them, the hobby, and this show grow all together. This has been Slabnomics Podcast. Keep building, and I will talk to you later.